Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. I've once again left highlighted in bright red on my daily chart the neckline of the August to November 2021 complex triple top, currently at 24.37. As it was and still is part of what I suspected 12 weeks ago was part of a new pattern, is a November 2023 to date descending scallop pattern. The bright red neckline plus the congestion between 2390 to 24.8, containing the July 2012 high at 2400 and a 50% Fibonacci line, the combined March to November and then November to December 2023 move, all these together provided overhead resistances. However, the subsequent move lower, change over or not, I think I will reduce the highlighting after this session. Now going back to the descending scallop pattern, this backward letter J pattern has finished its run upwards as the target on the upside for the run upwards in the 2405 area. And that was achieved 6 weeks ago, even exceeded a little indeed. This is the question I posed some 4 weeks ago after that, and I quote, the question now is what's next? Well, typically for such a descending scallop pattern, there are two pathways. You could expect a hesitation around this 2405 area for a short while before either a drop back down to the December 2023 low zone down in the 20 evens, or after a hesitation, a fresh move higher that will punch up through the November 2023 highs in the 2814 area. As I said earlier, we are in the hesitation part of the pattern now, and this could be a topping pattern this past week or weeks, or even, if we take it a little wider, possible bull flag. The only thing I would caution you is to watch out for false breaks in either direction. That's the end of the quote. Since then, we have seen a steady decline, almost at a bear channel that has, for the most part, run along down the underside of the purple highlighted upper time, currently at 2291, of the early November 2023 to mid-January 2024 bearish shift pitch walk. I said last week, and I quote, and it's a long quote, ideally you would expect by now to ascertain if this was a false break lower or not. However, it is such an orderly decline that it has elements of the previously mentioned descending scallop pattern, plus elements of a possible bull flag, a contrary pattern for sure. I put this down to the lack of any significant supports below, bar the congestion at 2235, all the way down to the start of some significant congestion at the November 2017 high at 2148. So in theory it could drop all the way down there, or even somewhat lower, and still be bullish. This is not an ideal situation, however, on balance I'll stick with the upper time of the bearish shift pitch walk until something better turns up, and that's the end of the quote. Well, last week saw a strong drive higher that failed at the overhead congestion between 2390 to 2408, containing that important 2405 area. And by midweek last week, prices had turned and dropped down to the then support of the flatlining short medium moving average, currently at 2252. We then had the changeover, and with gap lower, well into the stratified congestion zone, stratified all the way down. 2140 to 2148, 21 even to 2107, 2069 to 2076, 2047 and 2003. We have left behind not just a descending scallop pattern, but a changeover gapping move lower and a weekly key reversal down on the continuous charts. Should prices go all the way down to the low 20s, as they did back in late December last year, then I will likely have some significant targets below. One secondary target, which is currently off the bottom of my daily chart. It all now depends if the stratified congestion below will be strong enough to slow and even eventually halt the market before it has confirmed break below 20 even. Ice Europe, white sugar in London. The market has been wading through stratified levels of support below and turning it into resistances above. We now have overhead congestion around 750 to 752.20, containing a 50% Fibonacci on the January to September 2023 move at 652.20. Then further congestion at 635.30 to 638.20, containing the declining short medium moving average, currently 633.60. Then a band of previously mentioned stratified supports, now mainly overhead resistances, between 625.30 to 602.70 until we finally hit just below this congestion The October 2022 to date breached but not broken purple coloured uptrend, currently at 601.30, which is where we roughly are. We have further congestion below between 590 to 592.80 until we hit the December 2023 low at 585.10. And then nothing much until the bright red middle time, currently at 573.70, of which I will discuss shortly, and the February 2017 high at 565 even. When looking at what will be next, I said the following 4 weeks ago, and it is still valid, and I quote, it's quite a long quote. In the process of falling, hesitating and then rising, the market created, just like in New York Sugar, November 2023 to date, descending scallop pattern. This hesitation is around the original preliminary target of this pattern in the 670.90 area. The question here is the same for London and New York Sugar. What's next? Well, typically for such a descending scallop pattern, there are two pathways. You could expect a hesitation around this 670.90 area for a short while before either a drop back down to the December low zone, down in the 585 even zone, or you could see, after a hesitation, a fresh move higher that will punch up through the November 2023 high in the 772.90 area. As I said last week, and I quote, we're in hesitations. That's 2 weeks ago. Was that 2 weeks ago? No, it'd be 5 weeks ago. So that's 5 weeks ago. All I would add to this now is we seem to be getting ready to exit the hesitation phase, and that's the end of the whole quote. Since then, prices have a changeover gap lower and are much more advanced, not only in price but in certitude that we have a break lower. In some ways, more advanced move than in New York Sugar, such that, as I said last week, and I quote, we are realistically looking at a potential test down to the December 2023 lows, down in a 585 even zone. This prompted me to draw a bright red early November 2023 to late January 2024 bearish shift pitch hook. And though prices have not slid along the underside of the upper time, currently at 641.5 as they did in New York, the bearish shift pitch hook still shows the bearish angle of attack of the market, with prices in between the upper time above and the middle time below, currently at 573.70. Right now the market is testing the last significant support, the purple uptrend, for the December low and potentially some big moves further down based on a descending scallop pattern. It'll be interesting to see if these limited supports are strong enough to not only halt the decline but hold the market where it is. Sugar white premium spread. It must be close to, if not over a year here, that this chart continues to be one of the busiest and most colourful of all my charts. Many things are still going on all at the same time. Okay, so I'd previously spoken some while ago about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitch hook from 2019 to 2021, highlighted in dark blue on my weekly chart, with prices currently close to the lower time below, currently at 129.5. Now, I've said this so many times before and I will keep repeating here yet again. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle of attack of this market. In the more recent activity, we have seen prices around and on occasion down through all the moving averages, notably the long moving average currently at 130.5 and the medium moving average currently 140.25, but not so last week and this week. Prices had also been pushed down through the two big 50% Fibonacci lines at 128.75 and 131.5, as well as the June 2020 high at 134 even, but have moved back up through all of them, ending up where we are now, sitting just above the lower time and just above the June 2020 high. The lower time is highlighted in dark blue. It's actually in a relatively narrow range that we've seen the action. The market, despite some sterling efforts, continues to be trapped between the overhead congestion between 152.75 and 155 and the congestion below between 128.75 and 134.25. Further up we have congestion again between 162.75 to 164.75 and between 173.75 and 175 even. Whilst below, well, we don't know that much apart from the October 2023 low at 118.75. Now, the market could maintain itself sitting here between the nearby supports below and the resistances above, though it may have to make a decision soon as the dark blue lower time of the 2019 to 2021 bullish Andrews pitchfork pushes up over the 128.75 to 134.75 congestion support by the end of April. The question remains as to whether the market has enough ammunition to punch down through the congested supports and ultimately break the lower time and the longer-term bullish Andrews pitchfork. I'm still not sure on this point. You see, we had lower prices in September and October last year, but eventually they turned higher, leaving an island pattern behind, and the lower time was then down in the 113 area, not where we are now, approaching the 130 area. And nevertheless be paying close attention to what happens at and near the lower time. Just remember this, it requires a minimum of 2 consecutive weekly closes below the lower time to even consider it being broken. And given this market, I imagine it might need a few more consecutive closes than that to confirm it. I would only point out one other thing. Below the dark blue lower time is another lower time, currently at 117.75. This is not highlighted this time, but it's the August 2021 to September 2022 bullish shift pitchfork. That one might come into play if the highlighted blue one is properly broken.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.